Welcome to RBC's Markets in Motion podcast, recorded December 20th, 2022. This is Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, an update on our sector views following the publication of our December RBC Analyst Survey results. 3 big things you need to know. First, our analysts have a slightly positive tilt in their outlooks for performance over the next 6 to 12 months, as well as on other hot topics. Second, on our survey, our analysts were most constructive on the performance outlooks for healthcare and energy, followed by tech, utilities, and REITs, with the weakest outlooks for consumer staples, industrials, and consumer discretionary. Third, in terms of our own U.S. equity strategy sector recommendations, which leverage our analyst views as well as our own tools, we're overweight energy, financials, healthcare, utilities, and tech, and underweight consumer staples and discretionary. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that you can subscribe to this podcast on Apple, Spotify, and other platforms. Now the details. Takeaway number 1. Our analysts have a slightly positive tilt in their outlooks for performance over the next 6 to 12 months, as well as on other hot topics. In particular, their views on current valuations, the current state of demand, the impact of moderating inflation, future pricing power, and the impact of China's reopening tilted slightly positive. Views on where margin pressures and supply chain pressures are headed were a little more mixed. On overall performance outlooks, one thing that jumped out was that they improved slightly from our last survey taken in October. In our December 2022 survey, performance outlooks improved at the sector level for communication services, consumer discretionary, materials for the 3rd survey in a row, and utilities. Meanwhile, they deteriorated for industrials for the 2nd survey in a row. While the overall level of optimism on performance across all sectors and industries was still below December 2021 levels, the improvement was noteworthy in the context of the muted outlooks that have dominated sell-side strategy forecasts in recent weeks. Moving on to takeaway number 2. In our survey, our analysts were most constructive on the performance outlooks for healthcare and energy, followed by utilities, tech, and REITs, with the weakest outlooks for consumer staples, industrials, and discretionary. Looking at some of the other questions we asked, here are a few things that jumped out. Valuations are seen as most compelling in communication services and utilities, but least appealing in industrials, consumer staples, and discretionary. Additionally, moderating inflation is seen as a positive development for most sectors. Our tech analysts express the most enthusiasm about the impact of moderating inflation on their industries, and our energy and financials analysts see moderating inflation as a much less constructive development. We view this issue of moderating inflation as a key risk to our overweight stance on energy and financials, but supportive of our overweight on tech. The end of COVID-0 in China was seen by most analysts as neutral for their industry outlooks, though the camp that saw this as a bullish development was also pretty sizable. Our energy and staples analysts expressed the most optimism on this issue, while our financial and healthcare analysts expressed the least amount of optimism. Wrapping up with takeaway number 3, in terms of our own U.S. equity strategy sector recommendations, which leverage our analyst views as well as our own tools, we're overweight energy, financials, healthcare, utilities, and tech, and underweight consumer staples and discretionary. Most of these are calls that we had in place previously, but our utilities overweight is new. We have upgraded this sector from market weight to overweight. We do see our new utilities overweight as more of a tactical call, given our view that the U.S. equity market is likely to be volatile in the first half of the year, particularly the first quarter, before finishing the year on a stronger note. The sector tends to outperform in recession drawdowns and underperform in recession recoveries. In addition to a constructive outlook from our utilities team, we like the reasonable valuations of the utilities sector, which is only slightly overvalued on our model and well below the peaks of the summer. This stands in contrast to consumer staples, where our valuation model is still close to peak and more elevated than what we see for any other sector. We also like utilities' high dividend yield, its strong earnings revision trends. It joins energy as one of only 2 sectors with positive earnings revisions of late. Its tendency to outperform during extended yield curve inversions, something we've been talking about a lot in our recent client meetings. Its balance sheet profile, since it has the longest average weighted maturity of any of the major S&P sectors, as well as its strong ESG profile, according to the work of our ESG strategy team. That's all for now. Thanks for listening, and please reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.